back for another Talk About It Tuesday. And a lot of people are concerned about the economy and how to preserve whatever wealth they built over the last few years. So I love this question. Are I bonds a good equity to add to your portfolio? So let's just talk about the term equity. And equity does not refer to bonds. An equity refers to stocks. So in general, you'll hear equity versus debt, or stocks versus bonds. And there's a reason that they're usually pitted against each other. So in good economic times, companies perform well, so share prices do well. So people put more money into equities, right? Because your value is increasing, higher dividends. But when we're in an economic downturn like we are now, and if you've been paying attention to the news, you see the stock market plummeting. And so people want to protect against their losses. So they're saying, where in the world should I put my money? Because I don't want to lose it all in the stock market. So most people will shift towards debt or bonds. Now, the problem with putting your money into bonds, most people are familiar with the Series E bond, the Series EE bond, and those are U.S. Treasuries. And the Series EE bond, which is the one that most people know about, only pays 0.1%, although it's fixed and guaranteed, right, for the duration, and guaranteed to double in face value in 20 years, meaning if you put $50 in and bought a $50 bond, in 20 years it's guaranteed to be worth $100, plus the compounded interest at 0.1% annual. But that doesn't beat inflation, because in a good year, the inflation rate is 2 to 3%. And we're talking about now like 8% inflation, which is outrageous. So it's not a good hedge against inflation to do a Series EE bond currently. But the Series I bond, which most people are totally unfamiliar with, is relatively new. And it was designed to be a hedge against inflation because it has two interest rates. It has a fixed rate. I mean, the fixed rate is a joke because it's zero. But it also has an adjustable rate. And currently, the adjustable rate is 9.62%. And so that rate adjusts every 6 months based on what the inflation rate is. So it does not have the guarantee of doubling in 20 years, but it does have a guarantee that every 6 months, the interest rate can be adjusted. Now, of course, if the inflation rate goes down, then the adjustable rate goes down too, but it's a way to beat inflation, and it's a way to hedge against losses that may incur in equities. The other good thing about Series I bonds is that they are extremely affordable. You can get a minimum, you can purchase at a minimum of $25, but they put a cap on it though at $10,000. So you can do from $25, which is affordable for anyone, to a cap of $10,000. So it's extremely easy to purchase. You go to, I think it's treasurydirect.gov, and you can get plenty of information on it, and you can buy it electronically, so you don't have to have the old paper anymore. Everything is purchased electronically, stored electronically. So in terms of adding it to a portfolio now, well, you have to look at what your goals are. If your goals are to try to stem some losses that you're getting in equities, if it's trying to gain a better rate than what you're getting in a bank or in some other investments right now, then the Series I bonds is definitely something that you should be looking at. So again, you can go to treasurydirect.gov. It'll give you tons of information. It'll compare the Series E and the Series I side by side. And like I said, if you have $25, you can just hit a button and within seconds you can own it. To me, the only drawback is the maximum. The biggest drawback to me is that the maximum you can put in. So it's not like you can take all your money from, if you had a big portfolio, and just dump it into Series I. And there is a slight penalty if you take it out less than 2 years, which is not significant, but so you might have to keep it there a minimum of 2 years to get really the maximum benefit out of it. You can only keep it there a maximum of 20 years to get the interest that's generated on it compounded, and then the interest stops. So Series I bond, definitely something to look at, definitely something that most people should probably add to their portfolio. I love that question. Keep the questions coming. I'd love to hear your comments and suggestions for other investments too. But keep the questions coming, and I'll see you next Tuesday.